The daily reality of the commercial landscaping industry starts before sunrise. You load the trailers, check the routes, and deploy the crews. But as the morning sun hits the equipment on that ramp, the rising price of the tools themselves has become the primary bottleneck to scaling your routes. Over the last 3 years, acquisition costs for commercial landscaping and construction equipment climbed between 25 and 35%. This sudden spike has forced many contractors to delay adding new crews or stall their plans to replace aging, less efficient fleets. The numbers are staggering. A new commercial zero-turn mower now ranges from $18,000 to $22,000. For heavy machinery, a new Bobcat T76 skid steer costs nearly $68,500, an investment that was once far more accessible for a growing business. Despite these prices, top-performing operators are adding $80,000 in heavy machinery to their inventory with zero money down. They achieve this by bypassing traditional banks to use commercial finance marketplaces. Draining your operating cash to buy machinery outright might feel safe, but in the current market, it is a trap. It limits your ability to scale and leaves your business exposed to seasonal downturns or sudden economic shifts. Specialized equipment financing offers a way to preserve that capital. Because these loans are built specifically for the industry, they carry highly competitive rates, typically ranging from 5.99% to 7%. These rates are possible because the risk is structured differently than a general business loan. An equipment loan is self-collateralized, meaning the physical machine you are buying serves as the security for the debt. This specific structure prevents the dangerous credit clog. Standard loans or personal guarantees tie up your individual borrowing capacity, making it nearly impossible to secure funding for an emergency or a sudden business acquisition. Asset-tied debt isolates the financial risk to the machine. The lender's primary recourse is the equipment, creating a firewall that protects your personal credit score and net worth. By separating the debt from your personal balance sheet, you maintain your financial freedom and keep your long-term borrowing power ready for other strategic investments. Choosing the right structure is the next step in the ladder. For durable assets like excavators, where long-term ownership is the goal, the $1 buyout lease is ideal. It functions exactly like a traditional standard loan, and you own the machine for a single dollar at the end of the term. For rapidly depreciating technology, a fair market value lease provides low payments and easy upgrades. Additionally, modern lenders customize seasonal payment structures. As this graph shows, monthly obligations can rise during peak summer revenue and drop to zero during the winter. Aligning your debt to your revenue cycles is a primary defense against the spring trap, ensuring your equipment costs never outpace your actual business cash flow. Tax policy in 2026 has introduced a powerful multiplier for fleet expansion. Under the One Big Beautiful Bill Act, the Section 179 deduction limits were expanded, allowing small businesses to write off significantly more equipment in a single year, designed to encourage immediate and strategic physical reinvestment. This allows you to deduct the entire purchase price of qualifying equipment, up to $2,560,000, from your taxable income in the first year. This applies even with zero money down financing. You gain the asset, preserve cash, and significantly reduce tax liability. By pairing zero down financing with the Section 179 tax deduction, you essentially use the tax code to subsidize your company's physical growth. The final step in this strategy is timing. Successful operators follow the sun-shining borrower doctrine to ensure they receive the lowest possible rates from lenders. Many contractors wait until the winter to apply for funding out of necessity. However, applying when revenue is slow and reserves are low signals high risk to underwriters, which inevitably triggers higher interest rates. Instead, apply between May and September. During these peak months, your bank statements show high revenue and strong cash flow, making your business an ideal candidate for the most competitive terms. Requesting capital when the company is at strong on paper is the most effective way to minimize your total cost of borrowing. Accessing these specialized rates and seasonal structures requires moving beyond the rigid one-size-fits-all criteria of a traditional bank. Modern commercial finance marketplaces offer a streamlined pre-qualification process. It takes roughly 2 minutes, uses a soft credit pull that won't impact your FICO score, and accommodates varying revenue levels. A digital algorithm matches you with 3 to 5 tailored offers, and a funding advisor acts as an advocate to help you navigate the underwriting process at no additional cost. You can see your eligible rates today. Visit BusinessLoan.Directory to start the pre-qualification process securely. Scaling a successful commercial landscape operation requires a careful balance of both everyday operational grit and absolute financial precision. Professional enterprise management means acquiring the tools needed for today's growth while protecting the cash reserves you need for tomorrow's survival.